All right. Well, good afternoon, everyone. It's Joe Pochidiniak here with Ken Reed at McNichol and Associates Asset Management, and we want to welcome everybody to our music royalties as an alternative investment webinar. Really excited to be welcoming Michael Baker. Michael is a director with ICM Asset Management and is responsible for a wide range of roles there. Mike is a graduate from St. Francis Xavier University in Nova Scotia, and he holds a variety of industry relevant designations. We wanted to talk with our investors about music royalties because they are an alternative way of generating income, which we think is really, really important. Many of you are familiar with things like dividends that are paid from stocks or coupons that are paid on a bond. And so we're going to really mix things up here and talk about music royalties. Music royalties are the payments made to the legal right holder of a song or a song catalog. That can include the songwriter or the recording artist, as well as intermediaries like the music label. And really, it's a lot more nuanced than that. So I'm going to pull in Michael right now. Michael, welcome. This is certainly a webinar that I think a lot of our clients are going to find very interesting, and we thank you for being here. So over to yourself. Oh, and quickly before I compliance, yes, quickly before we get started, just a disclaimer that we're not in this webinar providing direct investment advice either about music royalties or in general. And if you do want help with your investments, we're always glad to provide it. So check us out at mcnicholasset.com. So Michael, over to yourself and welcome.
Thank you. Thanks for having me. Oh, we got a light outage here. One sec. There we go. Yeah, good afternoon, everyone. Thanks for joining us. I'll get Ken to just flip one slide forward there, and I'll maybe preface today's conversation by starting with a little bit about our firm. So ICM Asset Management runs strategies focused in a number of different sub-asset classes, but the common theme in all of them are that we operate in real assets. So from a firm perspective, we don't really want to invest into anything that's publicly traded. So if there's opportunities in areas outside of traditional stocks, bonds, or cash, we will look at it. So we run a few $1 billion on behalf of firms like McNichol, family offices, direct capital, right up to some of the biggest pension plans in Canada. But like I said, the common theme would be that we are focused in real asset ownership. In this case, we are talking about content or IP real asset in the form of music, but we're really just looking to kind of drive returns in a kind of an uncorrelated way, focus from real asset underlying performance and less broad market, public market exposure, if you will. So what we're talking about today is probably going to be pretty unique to a lot of you. And I'll try to keep it as simple as possible. I mean, I often joke with people that outside of tax law, content or IP law might be the most complicated subject matter out there. There's a lot that goes in behind the scenes, but in its simplest form, let's break it down at the top, okay? The reality is that anytime anybody digests music across any platform, there is a royalty right that's created and paid to that royalty owner. So let's use the simplest example. You log onto your Apple Music platform, you pick a song, you play it. It'll be fractions of a penny, but somebody is getting paid on that play. And it's a highly regulated industry, which basically means that it's governing bodies that stipulate how much of the total revenue pool actually has to be paid down to the rights owner. So the nice part about our platform is that when we go out and we acquire catalogs of music, meaning that we're actually buying the rights, or in many cases, buying the physical IP law, or the IP protection that gives us rights to these royalty payments, we're basically meaning that we're platform agnostic. So if we own, a song from Taylor Swift or John Legend, which we do, then anytime that title is played across any platform, being Spotify, Apple Music, TikTok, Peloton, whether it's played at the radio or in a bar or in an elevator, we will get paid a royalty rate for that. So that's kind of the simplest way to explain kind of what happens in the ecosystem. If you want to flip forward one slide there, Ken, there's a number of reasons why this would be appealing to an investor, and I'll quickly jump through some of these points without laboring too far on them. But number one would be from a correlation perspective, right? This is an income stream that we're generating for our clients that is kind of irrespective of what's happening in broader markets. Our returns are largely generated from consumer behavior. If people continue to digest content and we're paid, then it's an income stream that's a little bit more reliable than something in the public markets. The space is growing really quickly. There's new platforms coming to market seemingly every month. There's new ways of digesting content in which we would still get paid on. And we're kind of in an ecosystem where I think we have a slide on it in the future that I'll touch a little bit more on. But streaming is really the only economic driver of the music space that matters these days. I mean, physical music sales is basically on its way to zero from an economic perspective. That bottom left corner that says royalty rates are predetermined. This is really important. What this means is that the royalty rates that are paid, or the portion of the total royalty pool that's paid to the rights owner, is actually set by government statutes. And what that means is that once we've acquired the rights to the titles that we own, there's not really any action required on our end. It's not up to us to go to Apple Music or Spotify and negotiate and say, okay, this is how much we'd like to get paid. And we actually don't have to do any of the collection either. That's done through third-party collection agencies. So I don't want to diminish what we're doing here, but the reality is that the business model is incredibly simple, that once you've gone out and sourced the deals and acquired the deals, there's basically no action required on our end. The top right box, I think, is probably the hardest for people to wrap their head around. This might be the longest lasting asset class out there. IP law states that the royalty owners are entitled to royalty payments for the life of the artist plus 70 years. So this is, like I said, it's challenging to wrap your head around, but in many cases, when we're doing these buy decisions, we're underwriting 100+ year income stream. No operating expenses. So unlike something like a real estate asset, for example, that you might acquire and putting significant amounts of capital expenditure to improve a property, or you acquire land and you've got significant development costs to take it through a development cycle. With an asset class like this, there's very little, if no, operating expenses, meaning that, let's relate this back to what that means from an investment perspective. It basically means that your top line revenue is essentially equal to your bottom line cash flow, which is very rare in financial instrument. And the last point being that streaming is extremely resilient. I mean, consumers treat their streaming platforms a lot more like a utility bill than they would a discretionary payment. It's very unlikely that somebody would cancel an Apple Music subscription just because they've been laid off, or the economy's in a struggle, or something like COVID, for example. We actually saw the opposite effect. So the kind of the stickiness of that capital is really important. Ken, I'll get you to flip one slide forward there. So I indicated that we did put together a slide for you guys here, a little bit more on kind of what's happening in the music space, but in its simplest form, we are in an absolute bull market for music, and the only reason we're in a bull market for music is because of streaming. There was a lot of years leading into the kind of the early parts of the 2010s where music was really struggling to figure out how to monetize. You basically had a scenario where physical CD sales, LP sales were on a downward trend to zero, and streaming had not yet come to mass adoption. And so there was real problems with things like, Napster and LimeWire. I'm sure many of you would be familiar with people basically stealing music online and not paying for that content. And once streaming came around, it's really, like I said, become the only economic driver that matters. Goldman Sachs would be the most notable follower from an economic perspective of the music space, and they've got some pretty lofty expectations for where things could go by 2030. And as you can see from that yellow chart trending up and to the right, it's not as a result of anything other than the streaming space. So we're extremely bullish about where things are moving. And I'll get you to flip one additional slide forward there. Just super quickly, a couple of things that are driving this growth that I think you might find notable. The first being emerging markets. The reality is that streaming was born actually from the Scandinavian markets, where the Scandinavian markets have significantly higher penetration than the rest of the world on an average consumer basis. So Spotify, as many of you would know, is Scandinavian born. So they would have been kind of the first adopters, but the reality is that the majority of the world's population still does not have access to streaming. So as network capabilities strengthens, as technology capabilities strengthens, there's going to be some big tailwinds pushing the streaming space as a byproduct of those markets being opened. You think about the population base of an India or a Brazil, where the developed market penetration is significantly lower than the rest of the world. So, a stat that I always point back to that kind of always blows my mind is that 50% of the global streaming revenue is generated from the United States and the United Kingdom combined. Those two markets generate 50% of the global streaming market, and yet they make up a fraction of the population of the world. So we believe that trend continues as 5G capability rolls out, as the smartphone gets into more hands. It's only going to benefit the space. And then the other big piece that I'll touch on is from a device and network perspective. The part that I always joke about, which I find interesting about our opportunity set in front of us, is that other people are doing our business development for us. So because we're agnostic to platform, anytime that something happens where there's a new source to be able to digest content, we will get paid from that source, but we didn't have to develop that source. So even over the last kind of few years that we've been running the strategy, the number of line items that we're getting paid from on a monthly basis continues to grow. If you dated it back, 5 years ago, you might find that basically all of your royalty payments would be sourced from Apple Music, Spotify, Netflix, and maybe Amazon Music. And now we're seeing dozens and dozens and dozens of line items paying us as new services come to market, right? I mean, TikTok is a huge driver of returns for us, and that wouldn't have even been something that would have been a line item, call it 3-4 years ago. Get you to flip ahead one more time there, Ken. Won't spend a ton of time on this, but just kind of some emerging trends. I already kind of talked about these incremental revenue sources on the left-hand side there, which is only going to benefit us and accrete to our unit holders. The middle part is pretty important here too. This is an asset class that many times when we talk to our investors about, they say things like, "Oh, that's new," or "That's unique," or "I've never heard of that. I've never heard that you could invest into music." So it might seem new to the broad portion of the population, but the reality is that the big players, the quote unquote smart money of the world, has been investing into this for years, and their wedges are growing significantly. So almost anybody that you can think of, from the BlackRocks to the KKRs to the Apollos to the Ontario Teacher Plan. You might have seen the news that Brookfield actually just made a $2 billion investment with a firm called Primary Wave to acquire content music royalties. Anybody you can think of is call it the gold standard of asset allocation, are investing billions and billions of dollars into acquire these things. And it's for a lot of the reasons that I mentioned earlier. And then the market transparency side is only getting cleaner too. We're getting more, public market comparables. We're getting more indexability. We're getting more just because of the fact that there's more deals being done. You're getting more pricing information and price discovery within markets. So, 6 years ago, this might have been a little bit black boxy, and nowadays it's actually quite transparent. And I'll get you to flip one slide forward there. Okay, so I spent a little bit of time talking about kind of the space, the asset class, what we're doing, and I'll maybe spend a few minutes talking about what we're doing specific to our strategy, which might differ from what others are doing out there. But at the end of the day, it's not really rocket science what we're trying to build here. We're essentially trying to acquire a highly diversified pool of titles. So, I mean, we own thousands of song titles now within the portfolio. And we just really focus on acquiring them with a predictable cash flow stream. So maybe I'll actually get you to jump one slide forward, and then we'll go back a slide there, Ken, if you can. Yeah, because I think this does a really good job of kind of summing up what we're interested in buying and what we're not interested in buying. So maybe I'll start with what we're not interested in buying. What we're not trying to do is predict what we believe is going to be the next latest and greatest, or try to predict what will have an increase in popularity. So that would be represented from that red line there. So typically what happens in a scenario like that, and these would be best characterized as, call it, viral songs or one-hit wonders. These would be songs that experience very high streaming plays in the early years and have a very aggressive fall off tail where they basically, in many cases move to zero as listener interest changes. What we are trying to buy is titles that have a significant amount of dollar age. And dollar age basically would denote how long that song has been in market. So if something is, 2 years old, you just have much less data information on, where that streaming has trended. Is it trending up? Is it trending down? Do factors such as the release of new albums impact that? Do factors such as new touring or new partnerships, does that impact that? So what we're really focused on doing is buying something that we can accurately underwrite. And the only way that we can accurately underwrite things is if we have predictable cash flow for us to be able to pay a multiple on. So like I said, we're not trying to predict what the latest and greatest is. We're basically trying to acquire iconic titles that have very high staying power in terms of its streaming plays and buy it on that long tail of cash flow. And as I mentioned earlier, I mean, this is really hard to wrap your head around, but we are buying that tail of cash flow that in many cases can last for over 100 years. So for us to pay an appropriate multiple in a growing space for an asset class that could last over 100 years feels like a pretty strong investment thesis for us. I'll get you to jump back one slide there, Ken. Yeah, appreciate that. The other thing that I think makes us a little bit different from some of those massive names that you'll see on that previous slide when I mentioned that the Brookfields and KKRs and Blackstones of the world are out there acquiring music. They are, but you're seeing a bit of an environment where the top end of the market has a high number of aggressive bids, and the mid market where we operate has very few buyers. And what I mean by that is that I'm sure that you've seen some of the headline news out there with people like Sting or Justin Bieber or Justin Timberlake going out and selling their music catalogs for tens and tens, if not hundreds of millions of dollars. The reality is that the buyer pool at the top end of the market is very, very small. So when you're a firm like okay, let's use the example, you're Brookfield, right? You've made a $2 billion investment with Primary Wave to go out and acquire content IP. What happens in their case is that they're forced to deploy capital at very large tranches, right? They simply can't do a $10 million deal because it doesn't move the needle enough for them. So where we found a pretty good opportunity is buying things in that kind of $5 to $20 million deal size range, where it's far too large for an individual investor to go out and buy them, but it's far too small for a pension plan to be able to look at them. So we're finding opportunities to be able to buy things at much more attractive multiples than what's paid at the upper end of the market, with still getting some pretty iconic names. Want to flip forward a couple slides there, and we'll see where we can finish off with. So this is a little bit of a look on kind of the current portfolio composition. As you can see, diversification by genre is important. Diversification by age is important. I don't want to say that we don't care what we're buying, because we do, but we're far more focused on what the economics of that purchase look like, rather than focusing on the name of the artist that we're buying. So we've got a lot of names that many of you would be very familiar with, from the likes of Janis Joplin, Gordon Lightfoot, and Taylor Swift, John Legend, Lauren Daigle, The Midnight. These are not non-known artists, but like I said, we're far more focused on things like, what's the multiple we're paying for it? What is the growth rate of the catalog? What's the counterparty risk? Those are questions that we're far more focused on, instead of just trying to make a splash by trying to acquire the biggest names we can. So diversification, for us, is a byproduct of the deals that we look at. We're happy that we've got diversification by genre, and more importantly, diversification by age. So you can see at the bottom there that we've got over half the portfolio would be in titles that would be over 10 years old. And for us, that gives us a lot of certainty on, is the price we're paying appropriate for the cash flow stream? And if you're buying new titles, it becomes a lot more difficult. So Joe, I think that's a pretty good overview on what we've built here. Like I said, I'm going to try in the effort of your listeners here to not make it overly complicated, but that's largely kind of how the space operates and where we're seeing opportunity.
Yeah, that was really excellent, Michael. Thank you for that. Certainly appreciate the insight into this, really interesting alternative way to get an income stream going. And I really like the way you talked about the advantages or potential advantages of music royalty streams over traditional asset classes, the so-called long-only residual income streams. We know that music royalties can provide income for many years, long after a song has been recorded. And I think you really nailed it. Let's maybe at this point just get into some questions. We do have some questions here that have come in, and let me just take a moment to pull them up, and we'll go through them. Okay, so one of the questions we have is, music royalties seem like a great investment to add to an overall income-oriented portfolio. And I think you talked about it, but it seems as though a lot of the industry is only just now catching wind of this and adding it to portfolios. Why do you think that is?
Well, I mean, this is a tale as old as time, right? Where you've got asset classes that are typically seeded by, quote unquote, smart money and institutional money, and access on the quote unquote retail world comes much later. This happened with the ownership of private real estate. This happened with the ownership of private credit. I mean, if you look at you look at the bank's perspective right now, we're only now seeing Canadian banks, maybe get a little bit more lenient or open to the idea of offering something like private credit or private debt or mortgages to their clients. Those are things that have been invested for decades and decades and decades on the institutional side. So I don't think we have to make it any more complicated than the fact that, retail tends to lag institutional. And the people that have very, very, very large pools of capital are able to kind of seed these asset classes and figure out what works. And then once they've done the kind of the experiment to figure out whether it works or not, then there's groups that'll come to market and give other investors access to it. So I really don't think you have to make it any more complicated than that.
Right.
The other piece of it too is correlation and overall risk, right? I mean, people like to talk about alternatives as being non-correlated to the market, et cetera. We spend a lot of time talking to our clients about why they want to own assets directly in a private manner relative to owning them publicly. And a lot of the reasons come down to, correlation, return stability, a little bit more, you control the pricing, like those kind of things are true. But at the end of the day, like real estate, among other alternative asset classes, still have correlation to the broader economy. And what I like about the music side of our business, returns and income streams here are driven exclusively from consumer behavior and not from broader economic forces.
Right. No, I couldn't agree with you more. And we've got a real estate program that we've had in place for years, and we've been going direct to the private markets for a long time, and I completely agree with you. Let's talk a little bit about some of the risks involved, because this is an alternative asset class. So some of the traditional or conventional, I guess, risks may not apply. You sometimes hear about an artist owing back taxes to the IRS for many years. You of course hear about litigation risk. That's something I think our clients can understand. And then the reality is you could have a situation of multiple past relationships. How does that factor into the underwriting process when you're looking at a catalog?
Well, it all factors in. Firstly, I'll maybe touch on our process in the sense that we do all of our own acquisitions in-house. So we do not want to be buying these things on mid-market or kind of brokerage exchanges that are starting to pop up out there. And the reason we don't is that every acquisition is different. Every single one of our acquisitions, we will draft our own purchase and sale agreements. These are dozens and dozens of pages long that will protect us in different situations. I mean, if you've got an artist that, well, maybe I'll even back up one step further. The music business has historically had a reputation of people taking advantage of others. So you've got a lot of legacy contracts out there where you've got some manager that made them sign a contract so they get a spot on some tour date, and then he's entitled to X, Y, and Z. And so there's a lot less of that going around now, but certainly the contractual side of the business has never been clean in the music business, which is why each of our acquisitions have to be different. The big thing we do to mitigate a lot of this is actually withhold payment. So in many cases, we'll actually agree on a purchase price, but not pay all of that purchase price up front until certain stipulations have been met. And those things could be prepayment of accrued taxes owed. They could be the executed version of a management agreement buyout that they've got with another entity. So, there's not really one specific answer that I can give you other than that each one of these acquisitions is extremely different, and we look at all of those factors when making our buy decision. Right.
Right. And I mean, even dialing it up a notch, there have been times where the FBI has investigated artists. You've seen it with Jim Morrison, Trent Reznor. I think there was even one story on the deportation attempt of John Lennon, the late John Lennon. And so it definitely sounds like you guys are on top of it. Ken, maybe at this point, I'll just turn it to yourself. Do we have any other questions that have come in today?
Yeah, for sure. There's actually a few in the chat box that I'll ask Mike. Yeah, so the first one is, how do you value your assets after you acquire the catalogs? Do you use a third party? What discount rate is used? I think you touched on the first part of that question earlier, but yeah.
Yeah, so the first part of the answer is that we have an internal valuation policy. So the most important part of that policy is that once we acquire an asset, we have a 6-month period where we cannot change the value of the asset up. So what we can never do is, acquire something for $10 million and immediately say it's worth 11. You can't do that. More people often ask me about, the multiple that we pay for our catalogs, when in reality, the correct question that they should be asking is, what is the multiple that you paid for that catalog based on its growth rate? And because these are incredibly long-lasting assets, if you buy something for 10 times cash flow, but the catalog is decaying at 8% per year, that actually is a worse investment than us paying 15 times cash flow at something that's growing at 5% a year. So there's kind of two parts to the question. One is what we paid for it, and the second is how we're carrying it. And your question is more about how we carry it. So the answer is that we hold the assets at its value or lower if there's material impairment. We haven't run into that situation yet, but we carry it at least at purchase price or lower for the first 6 months. And then from there, as you kind of indicated from the second part of your question, it's really just call it a souped up discounted cash flow model that helps us arrive at our current values. And these are obviously all validated by our auditor, which in this case is KPMG. KPMG is probably the most well-renowned auditor in the music royalty space. They work with public groups like Hypnosis, et cetera, to do there. So they're pretty familiar with current valuation and trend. Our discount rate that we use, many would say, is on the conservative side. We use a 10% discount rate to value our current NAV on the portfolio. You'll find other groups using 6.5% to 8% kind of discount rates. But we're not trying to just make quick money for clients and exit this. This is a very long-term strategy for us. We hope that this fund is around for decades to come, and it's really kind of driving our need to kind of say, well, we don't really need to just aggressively mark these things up using a cheap discount rate for the sake of using a cheap discount rate. We're comfortable at 10.
Awesome. And then the next question was, would it be advantageous for an artist to invest in their royalties? I guess that's more on the IP side, on the IP law. If
But
that's even
in
allowed.
many cases, they don't have to invest in their own royalties. They actually own their own royalties. So when a song is created, and again, I'll try to keep this as high level as possible, but there's two sides of it. There's the writer's share and there's the composer's share. So somebody wrote the song and somebody plays it. Sometimes it's both. Sometimes people own both. But if you wrote and composed and performed your own work, in many cases, you already own your own royalties, and it's up to you whether or not you want to own them or sell them. Typically, an artist will want to sell their work or a part of their work as a way to monetize their business. They're looking for, not dissimilar to anybody else. I mean, if you could have a good cash flow stream, but maybe you want to buy a house or launch your own record label or record your own future album, and you want to sell some of your old work to be able to finance that. There's a lot of reasons why somebody would want to sell the income stream of their work, but it's your question relating to would they ever want to buy their own? They likely already own their own.
Awesome. And then there's two kind of questions that are quite similar to each other. Talking about music royalties on the streaming side, but then they also, both of these two questions touch on touring income and if that is included within the royalties of owning a music artist, or if that's too hard to track and capture on the fund side.
No, we can capture it, and again, I'll try to not complicate it. Please reach out to to Joe and team if you've got additional kind of deep questions, and we can get you answers. But the reality is that there's a lot of different types of royalties that you can acquire. In many cases, if we own kind of the full, like let's pretend that in some of our catalogs, which we do, we own everything, we would actually get paid on streaming, performing. You'd get, and then what your question is more on the sync side. So on the sync side, you'd get paid kind of more lump sum type transactions, and these could be live performances and even into the realm of commercials, for example. So if you've got a commercial for, company XYZ, some insurance company, they've got background music playing in that commercial. That's actually a sync licensing agreement that would have had been set up prior to the commercial airing that would stipulate how much the rights owner would be paid. Same thing for movies, right? If you see music in Netflix, for example, it's not the same as you just hitting play on your Apple Music playlist. It's a different type of content IP law.
Awesome.
I see there's a question here that says, can you resell them? Yes, but it's not our strategy. We're not looking to be transactional. This is a open-ended evergreen structure where we hope to continue to acquire additional royalty rights that are accretive to existing unit holders and benefit future unit holders. Not really focused on transacting.
Cool. And then there's a few questions actually sent in before we wrap it up, before the webinar on the sign up page. So the first one would be, are you concerned if you're trying to sell a certain song and you can't find a buyer? So I'm assuming obviously that's more of a liquidity question in the marketplace.
Again, we're not focused on trying to sell individual catalogs. The reality is that there is a marketplace for these things, and the marketplace continues to grow as the asset class sophisticates. So, it's not something that we're focused on. We really don't want to be transacting on these things, but yes, there is a market for them.
And then
a lot of it's to do with friction cost too, right? I mean, it's not inexpensive to do the underwriting and the acquisition and the negotiation. These are kind of ground up deal by deal. It's very different than going out and acquiring something on the public markets. So we also don't want to be selling and buying just because of the friction costs associated with it.
Awesome. And then the last question is, what is the correlation like between this asset class compared to traditional financial markets, bonds and equity markets?
The short answer is it's very low. As I mentioned at the start of the call there, I mean, this is an asset class its return profile is highly driven by consumer behavior, and other than values maybe changing as financial and the economic ecosystem changes, things like discount rates changing, et cetera, there's very little overlap with what's going on in the public markets. I also saw there's another question that we missed in the chat here about a history of low royalties being paid to the actual musicians or composers. Have you considered offering them a higher slice of the pie? The answer is that we have no ability in controlling that. The royalty rates and the portion of the revenue that's paid to the actual artists and composers is, like I said, it's set by government mandates. The thing that's benefiting us is that we're paid. We would be advocates of that as well, because if artists are getting paid more, it means that our fund is getting paid more, and the trend is that is happening. So the regulators tend to side with the individual rights owners making more of the pie. In fact, there's something called, not to make it too complicated, there's something called the all-in royalty pool, which moved from 10.5 up to 15 and then 15.1, which basically stipulates how much of the pie goes towards the individual artists. That's been trending up, and they've had some appeal from the likes of Apple and Amazon that were banging down the door trying to argue the opposite, but to no luck. I mean, the Competition Bureau is pretty focused on protecting the individual artists and not that of the big tech companies.
Awesome. And then I think there's one last question that was just submitted. How much of your past returns have come from royalty income and how much have come from valuation write-ups?
It is largely income. It's largely income. The reality is that we have to always be assessing what we're paying in terms of a payout ratio. Obviously, we don't want to be getting into a scenario where we're issuing tax slips for higher than we're actually generating in terms of yield. So as a broad statement, we're generating significantly more income than we underwrote. And so that income has to go somewhere. Either it's reinvested to grow the NAV, or it's paid out in the form of a higher distribution rate. And we have actually had to hike our distribution rate in the past. There's another question on kind of series and pricing. I'll let you guys discuss that offline with this individual client.
Great. Well, Michael, thanks very much for your time today. I know our clients really appreciate this very interesting new area in the alternative space with music royalties. Those royalty streams are certainly music to our clients' ears and portfolios, and we certainly look forward to growing this position in the future. For information on this webinar or any of our other past webinars, do check us out on Instagram, instagram.com/McNichol. Has a lot of great information about today's webinar, as well as our past webinars. And again, I want to thank Michael Baker of ICM Asset Management for being our speaker today. For Ken Reed and myself, have a great rest of your day and rest of your week. Thank you.